there's one asset that is not yielding into the space at all, even worse than stablecoin, it's Bitcoin. And the reason is there's no on-chain yield for Bitcoin, right? Like there's no proof of stake.
Right.
So and there's no off-chain yield as well because you don't have centralized lending since I've mentioned FTX. So what we're seeing now is a lot of products and some that we're launching very soon where our customers are essentially staking or collateralizing Bitcoin on chain. And then through a wrapper or bridging, this Bitcoin are allocated into DeFi or real-world assets.
Hey everyone, welcome to the Smart Economy Podcast, where we ask your favorite builders the questions you wish you could ask yourself. This is a production of neonewstoday.com, and I'm your host, Dylan Grabowski. In this episode, we are joined by Laszlo Szabo, the CEO and co-founder of Kiln Finance, a staking services solution provider. In this conversation, we discussed the hiring landscape in blockchain, how AI improves workflows, how staking has evolved over time, the forthcoming launch of RailNet, and how it will connect financial entities with on-chain products, why on-chain staking is bear market resistant, and so much more. Just a reminder, nothing said on this podcast is a solicitation to buy or sell any tokens, and that the host or guest might hold tokens discussed in any given episode. You can check out a disclaimer on www.neonewstoday.com. And if you enjoyed this conversation, please rate and review it on your favorite podcasting platform. Don't forget to share with friends and family. Every rate, review, like, comment, and share helps us reach more people to bring you more of your favorite guests. So, I really enjoyed this conversation with Laszlo, and I hope you enjoy it too. What's up, everybody? Welcome to the Smart Economy Podcast. Today, we're joined by Laszlo Szabo, the CEO and co-founder of Kiln, an institutional on-chain asset and yield management platform. Laszlo, how are you doing today?
Hi, Dylan. Very well. Thanks for having me.
Yeah, we were having a blast before hitting the record button. So I'm very much looking forward to the conversations that we'll be having here. And also, I do have to say that Kiln is a returning guest for the Smart Economy Podcast, but this is our first video interview.
That's right.
We interviewed Steve, former colleague. Nothing but great things that you have to share about him at Permissionless 3. So that was a really cool interview, and I'm looking forward to catching up and touching base with what Kiln has been up to. But before we delve into all of that, you're also the co-founder of Skill Hunter, which helps recruit engineers for forward-thinking projects. So what are the types of jobs that you're helping connect engineers with today? And is the job market viable for them? Is it good for an engineer who's looking for new work?
Oh man, you've been looking to my CV because that's an old one. But to be fully transparent, I'm still shareholder of that company. So yes, I started in tech more than 10 years ago before crypto by recruiting engineers. And that was my tech recruitment company called Skill Hunter. And I think, the idea was just at the time, it was really complicated for companies to find great developers. And usually developers wouldn't be able to, accurately find the best startups, scale-ups, or large groups that could hire them. Today, I think this problem has been, diminishing a bit. You have better connection between great startups and they communicate much better than they were communicating back in the day. So that developers usually, specifically the most passionate ones in crypto and AI, they often look for a specific company. And again, these companies have been better at brand employee branding and reaching out and communicating to the right developers. But though I'm still minor shoulders there, and I'm still recruiting sometimes. Part of my time, that's still I'm still a recruiter in many ways. And I can tell you that this company or this mindset really helped me by building Kiln and having the best people in the team. I guess that's our best assets for sure.
Yeah, I mean, if you go to the Kiln website and you look at the About Us, the team is pretty large. You have like 40 plus people working there. So, what's like the appetite for new market entrants? I guess maybe junior level folks, entry level folks, maybe even senior level folks. What's like the appetite you're seeing right now at Kiln for folks who want to work with you, or maybe just your industry peers? What's like the appetite for onboarding new folks into their companies?
Yep. Um, yeah. So we're 90 people. So like
Wow.
twice, roughly twice the number you mentioned. But though, it's like you don't want to. I don't think like number of employees is a good metric. I think you should be able to do a lot with a small team, or at least the smallest team possible, and the highest impact generally is something that everyone in a company really likes. So yeah, I think we started with DevOps, so SREs, right? Developers that will work on validators specifically, and most of these top DevOps, they wouldn't know blockchain prior. Their first job, most of the time in crypto, was at Kiln. So what we were looking at is huge curiosity, right? And also like, do you have a wallet? Do you know what staking is? Do you know what? Do you hold any ETH or Solana or Cardano? Do you know what a stablecoin is? Do you know what a security token or real world asset is? So these type of questions, though we wouldn't be overly indexing the fact that they worked at a crypto company before. I think what they really like is when you're DevOps, for example, is you get to work with decentralized ecosystem. You get to find problems you never find before, like there's a bug on the Solana, core validator tech that we deploy, or there's alt in that small blockchain, which happened to us in the past, when we were supporting running small blockchains. So that's one. Second is, of course, the DeFi landscape, which is evolving so fast. So everything smart contract, everything like on-chain asset management, you start to see more traditional financial backgrounds that come in to the space in crypto into Kiln to really understand, okay, how do I replicate that on chain, or how do I even invent new products that doesn't exist in TradFi in a blockchain? So I think that's the second wave. The first waves were like very deep infra type of employees, and the second is more like TradFi people entering the space and really being mind blown about this new financial ecosystem.
Yeah, it's amazing that the traditional financial institutions are finally here. One of the key themes that emerged over Ethereum Boulder, ETH Denver just took place last week was this kind of narrative around AI. And it's not like developers are getting excited about AI coins or how an LLM might be able to improve some processes a little bit. The overarching trend was that AI is empowering companies and entities to do more with less, kind of like what you were just saying with team size, quality over quantity. So, are you starting to see AI become a part of your processes? Is it seeping in to the workflows at Kiln? What's just kind of like your high level perspective of the integration of AI into our day to day lives now?
Yep. Yeah. I mean, I'm sure it's a question you ask yourself every day now as well, right? Like, how do I touch OpenClaw, or how do you use like OpenClaw and Codex, or and how do I improve my process? When it comes to us, we have a WhatsApp AI every Friday with the whole company, where like usually it's more engineering driven, where engineers would show how they use LLMs or agent orchestrators or agents in general to do a bunch of things. So I think like first AI and agents are really, really, really good at specking new UI, right? Like it's so easy for even me, a product manager, to like show to a developer what he means in terms of like user interface without even coding, right? You just have to script now. You have to voice. So you start to see a lot of more dashboard at Kiln there and there. I can tell you, um, and even nice design without our product designer to touch it. So I think this is really really exciting. The path to production, or the path to proof of concepting is much faster. Um, and then it also index us to focus more on the core tech, right? Because you know that the UI will be built much faster, sometimes like 24 hours a week. Before it was more like 6 to 12 months. So that's very exciting. The second thing is, I would assume that like roughly every code line at Kiln, except for smart contracts, are now highly generated by AIs. And of course, you need to review your codes. You still need to have an experienced developer to like look if an LLM or an agent orchestrator is you know, essentially going off course, because it often happens. But then when it comes to writing codes, writing tests, I think LLMs start to be really, really, really good. And we did like a quick survey. I would assume that more than 60 to 70% of the codes that is shipped at Kiln today is AI generated. I would say the only thing that is not well suited for LLMs yet, right? It might differ in 12 to 24 months, a smart contract, Solidity smart contracts. And the reason that is because you have less public documentation that you have on like Go or TypeScript or other languages. It's also a good thing for us because it still gives us an edge, right, of building a complex product that cannot be replicated yet. But I think it's 12, 24 months from there, like, I think Cloud Code will be able to write Solidity smart contracts very well. If they're not already doing it on part of the stack. But at least even on the smart contract, what we do is like all of the security stuff, invariance test, unit test, even pre-audits. A lot of that is already automated through AI. So I mean, yeah, man, it changed our workflow completely. And I guess, sorry to be long on that answer, but just like there's a pre and post way to build startups in this environment. Frankly, right? Like I still think a developer as its need, at least for the coming few years. You're right. It's hard to say indefinitely in that AI world, but this developer really needs to embrace the fact that it can 5x, 10x his productivity by just reviewing more things than like proper writing. Or again, when it comes to niche code, doing a lot of the process through AI and then coming at the end of the process and pushing production. That's mind blowing. And again, also on the product side and on other part of the team side of things, specking, pushing UI so that you come from 2 to 3 weeks type of UI to production flow versus it was 6 to 12 months prior. That's just insane how this will impact the way we build products.
Amazing. Yeah. So Ethereum developers, you heard it here first. You have 1 to 2 years left before AI takes your jobs. No, I appreciate that insight a lot, actually. It's becoming just commonplace across the industry that we're at an inflection point where it's not even being a little bit excited about AI. It's taking part, it's shaping the way that we do business, and it's integrating itself into our processes. So thank you for sharing your insights into the workflows and how AI has impacted the work that you do at Kiln. We will not make this an AI podcast, I promise. So let's maybe take a step back then, and let's talk about your genesis story with crypto. You and I have similar timeframes. Maybe you got crypto pilled a little bit earlier than me. So if you're like a lot of the folks we've had on this podcast, maybe you stumbled on Bitcoin or Ethereum, and then you overlooked it and came back a few years, not trying to put a story into your mouth or anything like that. So what is your genesis with Bitcoin, Ethereum, crypto? When did you first hear about it? When did you realize that this was something you wanted to be building in?
Couple of months for being full time into the space prior to you, man. So I don't think it changes much. But the first time I heard about Bitcoin was in 2014-15, when at the time I would just launch my tech recruitment company. I was finishing my hospitality studies, so really nothing related to tech. And I was in Hong Kong and then visited Tokyo at the time and met like randomly in Tokyo someone that actually was a very legit entrepreneur in blockchain crypto, the CEO of BRD Wallet, Adam Treadman, that would explain me Bitcoin, right? Like what
Wow.
Bitcoin was, this digital gold, decentralized network. I really loved the idea. I came back to Europe and bought my first Bitcoin 2014, 2015, back in the days. And then I was just kind of peeled by tech in general. And I had a friend in 2016 that would start as a developer in a company called Consensus. I mean, no, now it's like, you say Consensus in the space, it's evident, but I remember like looking on Google, it's like, okay, what's Consensus? What's a blockchain, right? I knew about Bitcoin, but I didn't know about even the world blockchain itself. And he mentioned to me Ethereum, decentralized applications, smart contracts, and everything you could do with it, right? Like, so kind of the vision for the world computer, going much beyond digital gold. And I started to dig. I bought some Ethereum August, I think 2016, and the price went up drastically up to January 2017. And I came back to my friends like, man, what is this? What's happening? So you gave me some hints and articles there and there, but you need to come. I was in the south of France back in the days, and you travel back in France from New York, where Consensus was. It's like, you need to come to the south of France for 2 weeks and explain me the thing, right? Like, what is this? So in parallel of doing my tech recruitment job with my colleagues and co-founders, I would invest in ICOs, right? Because now we had a little bag of Ethereum, and we were reading every white papers from like Legit project to Jesus on blockchain, and we would try our best, invest in these ICOs, and I think at the end of the year I was like, okay, I did my first conference events, and conferences or events, it's usually the same thing where there's so many passionate people in these places that you appealed, right? So it was in Paris, end of 2017. It was also, to be frank, the peak of the bull market. So you usually, as an entrepreneur, you get excited in bull markets, but the time you create the company, you're in bear market already, and you kind of like, you're fucked, right? But anyway, that's what happened. So I created a company, and I was like, okay, I'm a recruiter. The only thing I knew is recruitment. So I would put CVs on Ethereum to certify that you, Dylan, you've worked in that company on that missions. And I was trying to explain that to the French state, that they should give me, or at least the product, the network I was building, all of the French citizens' data, so that each French citizen could have a wallet and certified CV there in 2018. And they look at me in the eyes and they're like, "What are you talking about exactly? I don't get it." So it started well. So you pivot quite a few times and launched my first infrastructure company or product back in 2019, and then staking in 2020.
Were you running into issues with GDPR when it came to the on-chain
100%.
CVs? Yeah.
100%. Oh man. That's exactly why we pivoted. Because I mean, first of all, the French state didn't get it. But secondly, like, but are you putting like personal information or face recognition data points on public blockchain? Like, yeah, this is not GDPR compliant at all. So there was no way to reconciliate the fact that GDPR was existing, and that you needed to, at some point, put some information on public blockchains. Yeah, GDPR was not made for blockchains for sure.
Cool. So as we start kind of jumping out of the plane and coming down to the ground and talking about Kiln, I want to ask kind of like a high level philosophical question about staking. What's a strongly held belief that you had about staking 2, 3, 4 years ago that you've seen change over time? What's something that you believed so firmly a couple of years ago that your perspective has changed a little bit by today, just after being in this industry, building staking solutions for 6 years?
Yeah. That's an interesting question. I think maybe staking was the angle. But though it's also a question of like, as a crypto entrepreneur, you always see 6 to 12 months ahead. And it's, even if you have a long-term vision, well, capital market will be on chain one day, or every transaction value transaction in the world will be on blockchains. That's a 10, 20 years vision. But then it's hard to have like a 3 to 5 years type of roadmap, because you always stuck into the 6 to 12 months crypto market roller coaster in a way. So I guess, I thought, first of all, I thought I didn't get staking in the beginning. So I get proof of stake networks in 2018. You had Cosmos, Tezos, then Solana. So the first at scale proof of stake chains, right? You had like first primarily proof of stake, proof of concept, I would say, in 2014, 15, the name coins, the ARC, it's like some of these names.
Wow.
But you remember that? Yeah. Like,
Yes.
we are dinosaurs for sure. But like, the first at scale was like Tezos and Cosmos, and of course Solana. Then in 2020, but this market was very retail. So you had crypto investors in ICO that would then choose their validator to stake with. And I was looking at that market in 2018, 19. I was like, well, this is the retail play doing podcasts so that all these ICO investors stake on my validator. I had friends doing it, but I couldn't grasp how to do a great company around that. I guess what happened in 2020 is that you had this company called Bison Trails, which then has been acquired by Coinbase, started Coinbase Cloud essentially. Joe Lulus, the entrepreneur, the founder there, kind of explained the market that large platform at the time exchanges needed professional validator provider to offer staking so that they can offer staking to their users, so that you could access staking through Coinbase, Kraken, Binance, and all these exchanges at the time. And I thought, okay, this makes sense. And then I really grasped into staking as like as a product, as a yield product. And if proof of stake will be the way blockchain will be validated in the future after proof of work, because proof of work is too resource energy intensive, and then it doesn't scale really much in terms of TPS, transaction per second. The world is going to happen on blockchain, then proof of stake makes sense. And yes, it's really the risk-free rate of crypto, or at least the first yield that you can find there. I think what really changed is, well, this is only the tip of the iceberg, and this is only a small fraction of what's coming. And what's coming is capital market on chain. Finally, right? Where we were pitching 10 years ago, security token on private blockchains and all these buzzwords, it's finally happening. What we call real asset today. This is what's going to be the yields market moving forward, and you will be staking or putting at work your stablecoins in money market fund, private credit fund, stocks. Right, the real world just happening on blockchain. And this future, is quite exciting to me, and I wouldn't see that coming 2 to 3 years ago. And the last point I would like to just outline is that it's fascinating how the ecosystem, right? Because we work with the biggest exchanges now, custodians, wallets, asset managers in the world. It's fascinating how the crypto ecosystem shift from priorities from 6 months to the other. So I can tell you that a year ago, everybody would still talk about staking and liquid staking, but now everybody's talking about on-chain asset management and vaults and stablecoin yields and real world assets for sure. So and it's usually happened at the same time. Like it's across regions. I'm traveling quite a bit. Across type of category of clients, they all talk about the same topic at the same time. It's a good testament of how fast information flow and how fast this industry is moving.
Just really quickly, do you think that folks are talking about stablecoins and RWAs and vaults because we're in a bearish market right now, and those are relatively safe yield return strategies?
So staking is still a very good product in bear markets, right? Because if you're not selling, you better stake your assets, right? So you could argue that even in 2022 post FTX, that's the biggest staking growth, because the centralized off-chain yields after Genesis and FTX collapsed evaporated, and then the only remaining yields were on-chain yield staking, right, at the time. So usually bear markets are good for staking, but when it comes to stablecoin, you could argue that stakeable assets, let's take the two biggest, Ethereum and Solana, there's a percentage of stake that is capped because Ethereum says, I want to have maximum 30% ETH to be staked, and the rest to work into DeFi. And so I will decrease slightly the yield if we pass this threshold. And it's the same for Solana. Solana is just the threshold is a bit higher. We're talking 60, 70%. Versus what's coming is, of course, all these stablecoins have been doubling year on year, right? Like last year, we started the year with 150 billion stablecoin supply, and I think we ended at like 300 billion. So it really literally doubled. But a very large fraction, still 90% of these stablecoins are not yielding. And contrary to staking, there's no cap. You can imagine that regardless of how you're going to use these stablecoins, and most of the time you're going to use to transact them in payments, cross-border payments, FX, and these type of use cases. In the interim, I don't see why you wouldn't be yielding, right? You'd be yielding, and if you don't yield, you send your money to your friend, to your family, to whoever, and this person receiving the stablecoin will be yielding also by default. So you can argue that a majority of these stablecoin, maybe 80% or more, will be yielding. So that's first a very big market, and that's why if you need scalable yield in the stablecoin ecosystem, you need real-world asset, right? At some point, you need asset from the real world to influx real economy type of yields. So I guess that's one. Second is you start to see very interesting Bitcoin, for example. If there's one asset that is not yielding into the space at all, even worse than stablecoin, it's Bitcoin. And the reason is there's no on-chain yield for Bitcoin, right? Like there's no proof of stake. Right. So and there's no off-chain yield as well because you don't have centralized lending since I mentioned FTX. So what we're seeing now is a lot of products and some that we're launching very soon where our customers are essentially staking or collateralizing Bitcoin on-chain, and then through a wrapper or bridging, this Bitcoin are allocated into DeFi or real-world assets, and it generates a yield sometimes up to 5% on your Bitcoin. That's quite new. That wouldn't exist 6 months ago. And in the Bitcoin space, you have less than 1% Bitcoin bearing interest. So the opportunity is just massive. So yeah, stablecoin and Bitcoin, I think, would be the two assets we'll see yielding more and more, with real-world assets in the background in the coming months.
Yeah, I mean, there's like Botanix, Lombard, Bob, Babylon, all these entities that are starting to kind of enter the game for Bitcoin yield and Bitcoin staking. But we still haven't seen this really take off. I want to go back to when you mentioned ARK. And I loved the line that you were pulling on there, because ARK was one of the first staking coins that I ever held. Oh. And I remember thinking in 2017, wow, how cool. I can earn passive income on these crazy digital monies that I'm buying. And I loved that you touched on the fact that we kind of had to go out and politic as a validator node back then. Hey, I'll go on a podcast. Hey, I'll write articles for you to stake to my node. And as we've grown, also the kind of narrative back then was the institutions are going to come. The institutions will be here soon. And as we've grown, as you mentioned, with Bison Trails and being acqui-hired by Coinbase, we're there now. The institutions are here. RWAs are here. Banks are in the US and abroad are allowing their customers to hold in custody digital assets at the banks. We're seeing BlackRock with Biddle Fund. BlackRock made the most money it's ever made on any of its ETFs off the Bitcoin ETF. The institutions are here. And this is what I was really excited to talk to you about with Kiln, is that you guys have made this institutional play where you're providing the infrastructure and the necessary components for an institution to stake. So as we kind of come into what Kiln is doing, I guess maybe we can start the conversation with what are the biggest friction points that a traditional entity has when they are trying to onboard into crypto, whether they're trying to add Bitcoin, Ethereum, blockchain, crypto rails into their tech stack, or when they're trying to bring their RWAs on chain?
Right. Um, yeah, I think the first biggest hurdle is compliance,
Mm,
for sure. So they need to understand how um, the action they will be pursuing on chain is regulated, or if not seen by the regulator, right? Staking, for example, and you mentioned these large asset managers, BlackRock and the others. BlackRock started his journey into crypto, though, of course, I think it was the Circle investment, but the real journey was
mm,
January 2024, launch of the Bitcoin ETF. Then, after the launch of the Ethereum ETF, but they started staking only now, right? And the reason they're staking only now is because you had the SEC in September, October, starting to say, well, staking is not a security, it's a commodity product, and it's just like an extension or part of the blockchain network that is Ethereum to secure it and validate transaction. So that's one good example. The other thing is, of course, when they do launch a regulated product like money market fund tokenized, it's on chain, but it's still a regulated product. So they still need to pursue KYC with anyone investing in that product, or they still need to be, accrued investors in the US.
mhm,
And this will extend to essentially the vault space. And what vaults are, it's essentially a non-chain fund, right? It's asset management. What they've been doing off-chain, they will be doing on-chain, and on-chain means it's non-custodial. So it's better. You can allocate funds into an asset manager, potentially the largest asset manager in the world, that will pursue and run a vault to manage your money on chain in the future. The difference is they don't have access to your funds. They have permission of allocation into DeFi or into real world assets. And you can see what they do with your money in real time, which is not
mhm,
the case with off-chain product and TradFi or traditional finance, because it could be opaque. And it doesn't mean that because they're running an on-chain vault that it's going to be completely permissionless, right? Most of the time, they would need, specifically for the large asset manager, to have KYC at the vault entrance, right? Like they would need to check that you have a KYC linked to your wallet, or at minimum, if they use permissionless networks like lending protocols, they'll need to pursue KYT, right? Knowing that in a certain pool, you don't have like flagged
mhm.
taint funds from whatever sanctioned countries in that pool, even if all the users of that pool have non KYC. So there's um, all of these mechanisms which makes them comfortable to launch on-chain products. Today, we haven't seen yet one of the top 10 asset manager in the world launching on-chain vaults. I think this will happen in the next 12 to 24 months. But we are seeing more, I would say, traditional financial player like, the CoinShares or Monarch Falconex of the world that are thinking of like, how do I replicate my business off-chain, on-chain? And if they when they do that, they will, of course, think of like KYC requirements, and how these regulators around the world see DeFi or staking. If I need to offer that to my clients,
Cool. So let's talk a little bit about Kiln. I think from the onset, if anybody goes to put their Ethereum on their ledger, Kiln will be one of the entities that you can stake with. And maybe that's the only thing a retail user might know about Kiln, but you guys offer a lot more services. So maybe let's just jump off with what is Kiln and what are the wide variety of services that you offer for different types of clients?
right? Yeah, I mean, we pitch ourselves as the leading on-chain yield platform for institutions, which means we started with staking. As you know, we said it at the beginning of the podcast, 2020, then really grew from 2022 to 2025. I think the ledger integration you mentioned was a part of that growth. People could see Kiln or the Kiln widget, the Kiln app, and start to stake ETH from Ledger Live. But then we work with 200 clients across continents and across categories, exchanges, custodians, wallets, and asset managers. And then we also offer through Ledger, for example, but through all the wallets, stablecoin yield, right? These customers, they were like, well, I mean, I can stake my ETH, I can stake my SOL, I can have yield on my ETH and SOL, but what about my stablecoins? So we thought, okay, let's look in DeFi. We always offer on-chain yield, right? Like that's part of our core thesis and DNA, meaning we always offer yields that we never have access to the funds. It's either staking or we offer DeFi. And in DeFi, when it comes to stablecoin, it would be lending. So we start to offer compound or Aave type of protocol so that, Ledger or Trust Wallet or Safe customers would be easily able to access these lending yields through the wallets by just one click. So that was 2 years ago. And where we've been working for a year and a half, we thought, okay, there's this new concept that is coming in DeFi, which is vaults. And a vault is an on-chain fund, which will represent most of the yields industry in the coming years. But these vaults are ultimately very DeFi, meaning that it's most of the time a composition of lending. And DeFi lending, you can go in and out in a very liquid way, right? You don't have lockups or redemption times. But what we think will be the majority of DeFi tomorrow, as I said since the beginning of the podcast, are real world assets, right? Like as these money market fund, private credit fund, stocks, venture type of product or private equity move on chain. But the specificity of these real world assets is all of the time they are in the real world, so they have redemption time constraints, right? They are in liquid off chain, but they could be represented liquid on chain. So what we build is what we call railnets. It's a standards, the rails moving on chain, which kind of mix and standardize the way an asset manager can interact with DeFi, Aave, Compound, Uniswap, and interact with real world assets inside the same vault, inside the same vehicle. ACREDs, BIDL, as you were mentioning, of BlackRock earlier, or any stocks from Ondo, for example, which is one of our partner, so that users on chain will start to access products that only a few would have access to prior in TradFi, which is a mix between your lending and stocks and private credit. And you will start to also see, because of blockchain, new type of products emerging, right? Like, is it possible to take a private credit fund in TradFi and loop it 2 times? Maybe not, right? It's possible on blockchain. So yeah, I think this kind of view of the ecosystem and what RailNet enables is quite exciting.
You jumped ahead a couple questions jumping into RailNet, but let's go for it. So let's dig a little bit deeper into RailNet. When I look at it, it's pinned on the Kiln X account. And from the outside looking in, it seems like it is a cross-chain, cross-product type of offering. So what's the underlying infrastructure of RailNet? Does it communicate with various different blockchains? Does it communicate with various different DeFi protocols? Are you also communicating specifically with institutions that might be onboarding their RWAs? What's kind of like the umbrella of entities and protocols that are within the RailNet kind of environment?
Yep. Yeah, that's spot on question. So that's it. So we it's kind of an ecosystem that connects every DeFi protocols and any real world assets or real world assets issuers, right? That are coming on chain. And with everything that goes around that and all the complexity that comes with it. So real world assets, as I said, like a money market fund as T+1, T+2 settlement redemption times off-chain, or private credit fund might be 30 days, or private equity funds might be a couple of years. And RailNet will inject into smart contract, into that ecosystem, all of that data. Will tell you if an asset manager has allocated funds into BIDO, you still have 10 days of unliquidity off-chain, on-chain, and this asset manager will be able to essentially exit his position faster on blockchain because it's 24/7, it's real time. It goes at the speed of a block, 15 seconds, not 2 days or not a couple of years. But to make it more efficient, to make it to price this asset better, you need something like RailNet. And then, as you said, it standardized the way it connects all of these venues, DeFi and real-world assets, so that asset managers can start to offer product unified with a combination of all of that. We think in the future, it's going to be essentially an execution environment of all these positions. And specifically towards real-world assets, where you will be able, or the market will be able to trade unliquid assets off-chain, more liquid on-chain, in a more efficient manner. So, yeah, that's what RailNet is about. Standardizing through smart contract the way capital moves.
So is this kind of like an extra offering for Kiln, or are you going to be able to derive fees off of RailNet activity?
Yep. Yeah, I think it has such a big ambition, and it needs to be open by essence, that this might spin off at some point from the Kiln brand, because you could argue that some of our biggest competitor could use RailNet in the future, right? That's our intention. We want to make it open. We want to make it as anyone can build their own adapters, as we call it, or vehicles, to be more precise, vehicles on RailNet, so that they can plug in to the ecosystem and make their assets used by other asset managers, or even our competitors being their own asset managers themselves, if they want. That's the intention of RailNet, yeah.
I'm having a hard time grasping this concept because you're creating this internally. There's no sort of consortium. You want your competitors to use it. So from your perspective, is this kind of like a public good for the staking services infrastructural ecosystem more broadly?
It should be a public good in a sense that it needs to be open. There might be this concept of foundation at some point, but in the best way of things. And yes, this need to be grasped economically and as a product by a lot of actors. So because it's a standard, other developers can take this standard and say, well, the way RailNet works is it decomposes deposit and withdrawal flow on chain, regardless if it's DeFi or reward assets. And I can use that standard and help it to essentially adapt my own tokenized assets, or adapt my own DeFi protocol, so that asset managers will be able to use these DeFi protocols or use these tokenized assets inside the same vaults and offer yields to end customers. That's the first use case. But again, in the future, you can think of like maybe stocks or private equity products being more liquid on chain because of that standard, right? Because suddenly you know exactly how unliquid a real asset product is off chain, on chain, essentially.
And the tentative launch date for RailNets is Q1 2026. Are we getting close to a launch?
Well, yes, we're launching a primary version of RailNets in less than a month. I mean, I think it'll be even much more shorter than that. But I don't want to put more extract pressure on the product team, depending on when this podcast is releasing. But yeah, very very soon you will see great announcements with tier 1 asset managers that are onboarding into RailNets. and some of our biggest customers, right, the crypto platforms that will offer yields composed of DeFi and real world assets in the same vehicle. And I think, by the way, this has really never been done prior in DeFi. Usually you see either lending and sometimes you see real world asset, but as used as collateral in lending protocols. But you never see a product which combine a portfolio of like, DeFi, lending, LP's position, and real world assets inside the same bucket. And this is the ambition of what we're launching in the next weeks.
Very cool. There's an interesting tagline on the Kiln website that kind of sells or says why an institution might want to use Kiln for its staking services solution. And I think the kind of like eye-popping number is that you could, by using Kiln, save an institution 10 plus engineers and 10,000 hours for building a solution. So what are the kind of components? What are the kind of things that go into building an in-house solution? Why would it take 10,000 hours? Why would it take so many developers? Why is Kiln such a killer solution for so many institutions that want to engage in staking?
Right, for sure. And by the way, I think don't take these numbers for granted post AI world in 12, 24 months. And just say,
very good shout out.
I want to be highly transparent. In AI world, it's definitely hard to see how many hours you need to even build very, very complex in engineering products. But I guess it's super complex from the ground up because you need to deploy validators. That's what staking is about, right? Having at-scale validators, multi-cloud, on-prem, or in large cloud providers. We usually use 5 or 6 in different regions to have failover, to have diversity of validators in different cloud environments. And then you need to have the best performance, right? So you don't see that, but we usually outperform on Ethereum and Solana, for example, the largest, 2 largest staking protocol, our competitor or even the network by a couple of percentage points. But a couple of percentage points for an ETF or that, for example, that's massive, right? We're talking about like millions of revenue that they could get with us that they wouldn't get if they use an average validator on the network or just one of our competitor. And then you also have all of these data. So what we do is we index data on our validator, but on any validators in the network for 25 chain. So we run terabytes of data because we can provide to an ETF or whatever platform the data is like, this is the average yield on Ethereum, Cardano, Ton, whatever network we support. Or this is what you've been earning the past 30 days. What you think you will be earning the next 60. So this is part of our product. Then linked to that, it's the same set of product. We call it Kiln Connect, our APIs. There's the data part or there's the execution part. So a lot of our exchanges, fintech customers, they use our APIs so that when someone clicks the button, I want to stake my assets, it automatically sends their funds to our validators. Or when it clicks the button, I want to unstake, it unstaked automatically, right? Through their favorite custodian in the background, right? We work with largest custodian in the space, Fireblocks or BitGo and the others. So that's part of our stack. When it comes to DeFi, then, and still on staking, we run smart contracts. When it comes to Ethereum staking, 30 wallets, 30 of the top 50 wallets in the world are using, so MetaMask or Ledger or Safe or Trust Wallet using that. Because Ethereum staking, when you want to stake less than 32 ETH, right? 32 ETH is a validator. When you want to stake any amount, you need to use usually pooling smart contract that we developed specifically for these wallets. When it comes to DeFi, then you have to create this vault infrastructure, right? What Realnet is, which essentially it's a lot of smart contracts that need to be overly secured. and connect to any DeFi or real world asset protocol and standardize the way it's being interpreted on chain. So yeah, I mean, it's a bunch of product, man. It is, and if you want to be institutional grade, you need to show resilience, and you need to show this level of seriousness and security to your customers. If you want them to stay on the platform.
So, kind of along those lines, the industry and just the vertical and the asset class that we work within is still new in the grand scheme of things. Bitcoin launched in 2009. We're not even 20 years old. Like, if it's in the US, it can't even buy a pack of cigarettes yet. So, how do you kind of maneuver the risks that come with a growing nascent industry? And largely, what I really want to talk about is, what are the lessons that you've learned over the years for choosing which DeFi protocols, which stablecoins, which ecosystems to provide services for? I'll give a few examples. In 2020, 2021, Anchor would have been a fantastic stablecoin kind of solution because it offered 20% yield, but that collapsed. Not to denigrate any ecosystems, but again, in 2021, Cosmos was like the meta. That was some of the greatest yields that you could get on staking. We're rife with so many of these during their time, during the present moment. A lot of projects were great, DeFi, stablecoin, and ecosystems. But as time has shown, they don't always stand the test of time. So, having to understand that this is an inherent part of our asset class and our industry, what are the ways that you view choosing which DeFi products to use, choosing which stablecoins to provide yield for, choosing which ecosystems to provide staking services for? How do you kind of look at new projects and integrate these into Kiln? And what are the lessons learned over the years that you kind of add to your checklist as we just keep growing and becoming older as an industry?
Yeah, it's a very, very good question. And I think this is a very big part of the value prop that we offer our customers. So our head of asset management is called Darchin, and he was the CEO of Credora. Credora is the only, for a while, but I think still is, rating system in DeFi, right? What they would do is they would rail vaults, lending vaults at the time, where they would rate the collateral asset, right? Like what is being used by a curator or an asset manager as a collateral to borrow some assets. Then they would look at LTV, right? Loan to value ratio, and how certain DeFi pools would be used, would be managed, how risky there is of a liquidation to happen. And then you go through, of course, the security part of a DeFi protocol. You go through the audits, how many good auditors have been looking at this smart contract, though it's never like a future-proofing type of approach, but it definitely helps. And there's a handful of very good auditors that you usually always trust, or most of the time trust. The always term in crypto is a bit going too far. But then you also have the team, right? It's like who's the team behind it? How long they've been building? Who are their investors? What's the balance sheet? How much do they invest in security? Do they invest in compliance? Or kind of all of that. And in the end, so you, of course, do the diligence on DeFi protocols. Of course, do the diligence on the assets itself, the real assets. How risky a certain asset is. But and of course, you do the diligence on the market liquidation and smart contract risk. But then you look at the asset manager, right? Like, we think in the end, you will trust an asset manager. You will trust a TradFi brand to put your money at work so that you get interesting yield, but to minimize the risk. And if we're talking 25%, 30%, maybe you should ask yourself a question, right? Like, where does this yield come from? Which magic it? Where is my position going to? Which DeFi protocol or stablecoin hedge fund they're using in the background? And that's why we've been partnering with tier one asset manager. I think what we've been seeing now in blockchains is players like TradFi asset managers or tier ones in crypto are increasing their on-chain product because they see this new type of capital which could be allocated to the products. And the other way around, the users need to understand and be comfortable with a brand that they believe in, that could manage the money well. So I think a combination of all of that, we have this insight risk tooling that we offer our customers. It's even like these are dashboard with red, yellow, and green type of colors, and so we rate these collateral, these DeFi protocols, the teams, the risk of smart contract, and the asset managers, so that we could offer the best asset managers to our customers with the best type of yield product on Ethereum, Bitcoin, or stablecoins. But I think, I don't know if you followed stream finance events in the vault category. So I think that happened in end of last year, and essentially what happened here is you start to see asset managers. They call themselves curators, but to us, these are asset managers on chain that don't have the risk analysis and the seriousness of themselves doing the due diligence. Where do they allocate customer funds to which DeFi protocols? They take shortcuts, and they took shortcut in that stream finance, which was essentially a stablecoin hedge fund that would take some stablecoin money and put it into off-chain exchanges and having basis trade type of strategies, but sometimes in a very risky way, or even on non-KYC exchanges. And you could see, if you had done your proper due diligence on stream finance, that, well, this is not something a serious asset manager should touch, right? And I think, I hope this event showed that we still need more professionalism into the yield space, and it's coming, I can tell.
Awesome. As we kind of end our time and wrap up and zoom out, I want to ask about a philosophical kind of under-discussed question about the risks of staking today. So when we look at what could be kind of like a black swan moment for staking, what do you think is the least discussed potential problem? Is it client concentration? Is it correlated slashing? Is it oracle or bridging dependencies? Contagion from restaking? Capture from DAOs and governance? Or is it something else? And how do we kind of prepare for one of these massive black swan events and design our systems to be resilient?
Yep, for sure. I think correlated slashing is something that most of the end users, I would say a big part of institutions, don't really understand as a risk, because it's so infra. It's not as transparent as like smart contract are, because at least smart contract, anyone can look at them on Etherscan in real time. Correlated slashing is always linked to validator keys, right? And you need to secure your validation keys as much as your fund keys. That's the first thing. We're using MPC technologies or HSM, and sometimes, most of the time, these keys would be in clear on the machines. And the reason for that is the tech that will secure these keys wouldn't be mature enough, because the market would be too narrow, but the risk is still present. So I think this has evolved quite a bit. But as we are evolving the technology, and as we are securing these validation keys, we still need to spread your stake to either multiple providers, or at least different setups, different cloud environments, so that you spread the risk when staking your assets. I think that's one for sure. The other one would be the smart contract risk of liquid staking protocol, without naming them, because they are our best partners. Sometimes of course, concentrate a big part of the stake. And we better have these smart contracts super secure, and approved by time. So using different solution there always makes sense as well. Um, yeah, and I think again, I think as we go over time, and we've went through it, quite a hard time. We're just improving the way we secure staking in general, validation keys in the first place, smart contract in the second place, and how do you make a yield that is as risk free as possible. But I can say that the market from 2018 to like a retail market where you had hoodie validators runner that will run validators on their machine in their room, from like institutional providers that spend millions per year to secure their infrastructure. The ecosystem changed completely for sure, and it will continue to evolve.
So the last question I want to ask is, if you go on crypto Twitter right now, you see a complete dichotomy from reality to sentiment. Everything is in the gutter in crypto Twitter. There's no hope or future for our asset class, for our industry, for this technology. Meanwhile, we have institutions onboarding RWAs. We have all these great products that you've been talking about, this whole podcast. The future has never been brighter for our technology. It is being integrated into our day-to-day systems. It is being adopted into the mainstream zeitgeist. But people on crypto Twitter are negative. So for the first time, the first market cycler, who this might be their first bear market or their first negative sentiment moment, what do you have to say about all this? Where's the disconnect, and why is it just noise and it doesn't matter?
Yeah, it's a good point. Because we've been waiting for this narrative to happen for years, right? Remember 2018, Dylan, we joined the space, and back in the days, we're already talking about capital market on chain and security tokens, and now it's happening. Like, real world asset curves like booming. You see a TradFi company every week announcing that they will use blockchain as their settlement layer, and it's public blockchain, not private blockchain anymore. I think the disconnection comes from the fact that, first of all, there's uncertainty in the world, so it impacts price and impacts sentiment of people. But quietly in the background, these institutions are moving. They are adopting the technology better and more than ever. And yeah, I think it will take maybe a couple of years for the world to realize, or not even to realize, that the way value is moving in the world is happening on chain, right? From stablecoin to real world assets to you buying anything and potentially buying books or buying groceries with your Bitcoin. Finally, this will be like a realistic future, and this is super super exciting. But maybe it's just the shepherding versus the world when we entered the space in 2018, where we're essentially discovering. We were the Christopher Columbus of the space, and now it's finally happening. So people might not be excited anymore by a quietly, quickly advancing reality. But to me, it's much more exciting than what the market tells today.
100%. Our technology is being used and it's being adopted, which has been the dream since we entered the space in 2018. Laszlo, thank you so much for giving us an hour of your time. This was an awesome conversation. I had a blast chatting with you. For anybody who wants to learn more about you or get in contact with you, what's the best way they can reach out to you and or to Kiln?
Yep. And thanks for having me, Dylan. And I know you'll be in Europe, so let me know when you're there. And you can contact me on Twitter. You can contact me on LinkedIn. I'm still trying to be a TradFi or institutional person in the end of the day, and so I'm trying to look like a boomer, even if I'm not. So you can contact me there as well. And yeah, I'm often also in conferences. So if you're crypto passionate and you go in these conferences around the world, please stop me, and we'd love to have a chat.
I'll find you at the next conference I'm at, Laszlo.
Let's do that. Thanks, Dylan.
All right, cheers. Thank you so much for tuning in to the Smart Economy podcast. To stay in the loop with all of our latest episodes and insights, head over to www.smarteconomypodcast.com. And don't forget to subscribe to our YouTube channel for all of our video content. And if you enjoyed today's discussion, please consider showing your support by liking, commenting, and reviewing this episode on your favorite podcasting platform. Your feedback helps us reach more listeners and brings even better content your way. We'd also love to hear from you, so please drop a comment on Spotify or YouTube to share what topics you'd like us to cover next or who you'd like to see as our next guest. And if you or someone you know might make for a great guest, please don't hesitate to reach out. We're always on the hunt for fresh voices and new perspectives. And for our NEO token holders out there, please consider voting for NEO News today as your council representative. We've proudly been serving the NEO ecosystem since 2017, and we'll continue to do so by putting portions of our council rewards directly back into ecosystem growth initiatives. So once again, thank you so much for listening to the Smart Economy podcast, and we look forward to catching you next time.